Well, hello again, everyone, and welcome to the Options Mentor. Well, once again, we've had kind of a busy week in the market. The market looking a little sour on itself, worried about interest rate hikes, worried about just the economy in general, and also some concerns coming out of China. You got to keep an eye out on those because I've seen some huge moves off of things in the Chinese economy before. So just keep an eye out there. It doesn't mean you can't trade, but it's just things to be aware of. So this week, what I'm going to talk about is a trade you can use when you anticipate a very large move in the SPX, or I'll show it also in SPY for a less expensive option. Now, you really need this move to happen within a couple, maybe 3 days at the most of when you put this trade on. Now, once again, this is when you're anticipating the move. So many people come to me after an 80-point down day in the SPX and go, Mark, should we put on a back ratio? Well, you missed it, right? Unless you think it's going to move again over the next day or two, another 80 or 100, well, then you could do it. But this is not something you do after the market moves. You want to try to get this on when you anticipate it. And sometimes when the market gets jerking around pretty good, you can tell, and it's a pretty safe bet. And I had one of the commenters ask me what to do about large moves. So I'm going to cover my favorite trade for that today. It worked very well for me in 2020 when we had all the COVID blow up. It made me a lot of money. So it's a great trade, and I'm going to show it to you here. Let me share my screen. By the way, you probably noticed that this came out a little bit later. I normally have my videos come out on Friday, but Friday I did do this video, but I forgot to hit share screen. So all you would have saw, maybe you did see it or early, was just my smiling face. Then somebody let me know there was no screen share. Well, you really got to have that. So now I've had to redo it here today for you. But still, it would have came out after market Friday. Now it's going to come out still before next week. So you should be fine. And not only that, I don't know that this week's going to be the week for this trade. I just think it's great to have it in your quiver as another arrow in your trading strategies. But what you can see here on your screen is the VIX. The VIX has been going up, up, up. The market's beginning to get a little nervous. There's put buying, there's call selling. You can tell the big participants in the market are beginning to be concerned. Now, this happens, the VIX normally goes up whenever SPX goes down. Why? Because about 80% of all the participants in the market are long. If you think about all the funds you're in for your 401k or what have you. So 80% of the market is long. They don't care if the market goes up forever. There's no anxiety about that. But when the market looks like it's going to come down, now people are worried about losses to their long positions. So that's why there's more nervousness, volatility, fear, however you want to put the term, whenever the market looks like it may come down or it has been coming down. So in this situation, what I like to do, if you go over here to SPX, and once again, I'm going to show it in SPY also for a less expensive alternative for those who want that. And if we go here to SPX in the Analyze, you can see the trade already on your screen, but let me talk about it. This is what we call the back ratio spread. Now, there's a lot of different ways you can do it. There's a lot of ratios you can use. But what I've found over the years, what works best is to do a selling 2 calls that are out of the money and buying 3 calls even further out of the money. That is the best way to set up this position. If you look at this graph on your screen, if there's a big move, you're smiling big, right? Because perfectly fine with you. What if we do go up 80 the next day after you put this on? Well, who cares, right? You just picked up $1,400 or so. Now, I want you to realize this trade is long Vega. So volatility can come down up here. It might not be quite that much money, but you should still be fine. In fact, you probably would make your most money if the market did go up hard, but you'll do perfectly fine if it goes down too. And the good part on the downside is it could go all the way to 0 and you'd still make money because you put this on at a credit. So what I do structurally is I normally, I've done a lot of things over the years where I was using, say, a 35 delta, a 45 delta. That's when I'm selling. Generally speaking, you're probably in the mid 40s now with the one you're selling. But what I try to do, even more important than the delta, is I look for a strike that's just above what we're trading in a big round number. What do I mean by big round numbers? 4,400, 4,425, 4,550, 75, and then the hundreds, right? So the hundreds to 25s to 75s to 50s is what I normally sell. Doesn't mean you have to, but those are usually fairly liquid. Now, another thing about this trade, it's very much susceptible to theta decay. So what I like to do is I like to do this trade about 12 to 18 days out in time. That's the expiration I pick. You can pick any expiration in there that you like, 12 to 18 days out. And you only want to be in this trade for 2, maybe 3 days at the most. So this isn't a trade, for instance, that you'd very often put on a Friday, because you're going to give up 2 days right off the bat. You can if you really think Monday's going to be a big day, but generally I put these on Monday, Tuesday, Wednesday, probably most of the time. I have put them on Thursdays and Fridays occasionally. And what I do is I'll go up. Here we are trading here, or we were in the SPX at basically 43.70, 43.69. I just went up to the 4,400, and then you can go 40 or 50 points wide. I do whatever makes the graph look best, one, and also I want a minimum of an $8 to $10 credit. If you see here, my credit is $11 or $1,100, and I did it 40 points wide. Now I looked at the 50 points wide. Let's look at it together. And if you go 50 points wide, you get an even bigger credit. But if you look here, it's underwater a little bit. Now it would probably be all right if you exploded up here, but it's just underwater a little here. So sometimes when I see that, I creep in here and I do 40 points wide as long as I can get that credit of $8 or $10 or more. And I get $11. And now look at this. If it runs up, I'm doing well right off the bat. Now, another thing about this trade, when you do put it on, as soon as you get that big move and you're profitable, take the trade off, particularly on the upside. Because as I said, this is long vega. Volatility drops often when the market makes a large up move, and you will rapidly see your profits evaporate. So I mean, as fast as you can, if you get an up move, take this off. If I put this on, if I somehow could today, and I woke up tomorrow morning and I saw we were going to open up 80, I would be right at the screen ready to sell this right when the market opened, because I want out of this before volatility affects me too adversely. Now, on the downside, if it happened, you have a little more time, but you don't really want to hang out for days on end, seeing if you can get more time in, because on the downside, ultimately, you will go positive theta, as you can see. You know, if we went down 100 and stayed down, you make back the full credit eventually. But I do really like to get out of these extremely quickly on the upside with a gain, and pretty quickly too on the downside. So I did this one 40 points wide. We put it on when we anticipate that. Now, this trade, as I said, it is expensive. If you do it 40 points wide, it's $8,000 in margin. If you do it 50, it's $10,000 in margin. Now, I don't ever do it any wider than 50. Oh, and by the way, I know this question to be coming quickly. This just absolutely does not work with puts. I've tried every configuration you can think of to set up a put ratio, and it is just terrible. For one, I've found to get any credit in puts, many times you have to be like 80 points wide with your spread, so the trade's very expensive if you do that. So just forget about puts. You don't need puts anyway. This works perfectly fine with calls. So I have this on here in SPX. You can see it, like I said, it's $8,000 less the credit. So this would be about a $7,900 trade. I know that's expensive. The one thing about it, though, mild comfort, is when you have 7,900 at risk here, you're not waking up tomorrow morning and your money's evaporated. You know, a lot of trades, if we had a huge market move, you'd have a total loss. Of course, you won't in this one. If we had a huge market move, you're in great shape. But also, it does go against you a little slower. Look what happens if I just say go out to a week or so. And yes, I'm down bad on theta, right? If I'm up in here, this is why you don't want to hang out in this trade. But you're nowhere near that kind of huge, gigantic loss. It is, yes, you do have that at risk. If something happened and you didn't pay any attention and you went all the way to expiration and this trade ended here, yes, you would lose that $7,900. But this is a trade that you have plenty of time to manage before that ever happens. And indeed you should, because you should only be in it about 2 or 3 days at the most. So in SPX, it looks like this. You may be able to move it around. You may be able to do 44.25, 44.75, whatever you want to do. You can look at that. Just remember the basic criteria. We want an $8 or $10 credit in the SPX. We want a graph that looks like this, where, hey, if it takes off in either direction, you're making good money. And that's what it's about. And we want to do it 12 to 18 days at the most, at the least 12, and at the most 18 days out in time. Now, over here on the SPY, all those things about timing and expecting the market to move are the same. What's different is, well, it's 1/10 the size. So what would I be looking for? Well, I'd be looking for an 80 cent to $1 credit, right? Because it's 1/10. And if you look at it here, also it is 1/10 of the price, $800. So if I do this one here in the SPY, I just went 4 points wide. If you wanted to go 5 points wide, you could, but that's how this would set up in SPY. Now, if you ever wanted to do SPY or even SPX any bigger, you could do that. Just keep that 2/3 ratio. I'll show you here in SPY. So if you said, Mark, I'm willing to risk more than basically $700, $800 less the credit. Okay, then what you could do is you could put it on twice. Now, twice would mean twice of everything. So now I'm selling 4, if you see here, and buying 6. So when I do that, you can see my margin doubled from 800 to 1600. And I would now be making 2 times this $1.11 credit. And you keep going up from there, selling 8, buying 12, that kind of thing. So that's how you would do this if you wanted to scale up in the SPX or in the SPY. But this, as I said, we hopefully you'll have this trade and know this trade, of course, whenever you need it. It could be this week. It could be October. Who knows when the big moves are coming? But whenever we start getting violent moves one way or another, or you anticipate them, it's the time to try to put this on. Now, one thing about it, even in the SPX, let's say I put it on today, and then maybe, it gets in here 3 days, and you're down a little. You say, okay, I was wrong, take it off. It's not a trade that's generally going to hand your head to you, right? If you're wrong, just get out in 2 or 3 days, take a small loss and say, all right, I was wrong. We didn't get that big move. Or maybe you get 2 or 3 days in and you go, wait a minute, now I really think I was just a little early, but we're going to get it. I'd probably take this off and put on a new one with that appropriate timeout, 12 to 18 days, expiration out in time. So this is the back ratio. I do it 2/3. I've had a ton of success with this trade over the years. Try it on paper, see what you think of it. As always, tell your friends about this channel, subscribe to this channel. I offer this options education. I think it's a great enhancement to the beginner and the experienced trader. As always, I appreciate your comments. You can send me emails there through YouTube if you have any other questions. And try to like my videos if you like them. I've had pretty good luck with that. I think the videos so far have come across very well for folks. I think they see that there is some things that you can do with some non-directional trading, primarily using options to enhance your trading. As always with trading, you shouldn't do anything that you don't understand, that isn't right for you and your risk tolerance, your portfolio, where you're at in life, what you're trying to accomplish. So this isn't for everyone, but this is a good general options education for when you are ready, if you're not ready now, to use some options to enhance your trading. But I will be with you hopefully this coming Friday. I'll have another video. I'm hoping this time not to forget to share screen. So I'll talk with you guys then. Have a good one, and bye-bye.